S&P 500's bull market is here, at least if you talk to most people. It doesn't quite feel like it, though. In today's morning brief, Yahoo Finance executive editor Brian Sozzi outlines the trends he's seeing that are remarkably unbullish. He gives a few examples here. Target stock being downgraded on slowing shopper habits, Campbell's cheaper soups gaining traction, and CEOs planning for major layoffs and cautious holiday shoppers. With conflicting signals, what does that say about where the market goes now? Investors are split on that matter. Morgan Stanley respectfully disagrees that the bear market's even over due to earnings forecasts for the year ahead. Analysts pointed to the bear market of the 1940s, which rallied 24% before hitting a new low. On the other side, Goldman Sachs is optimistic, lifting its year-end target for the index to 4,500 and arguing the S&P 500 could keep climbing as other sectors start to catch up with tech's stellar performance. Let's bring back Kevin Gordon, Charles Schwab, senior investment strategist. And this is exactly what you were just discussing. If you look at that Goldman note this morning, it's really interesting. And they have some various charts that show to such a degree that those few number of stocks have been accounting for the rally here. I think that they looked at mega cap is up something like 47% year to date, while the S&P is up much less. We've seen a little bit of signs of broadening, though.
Yeah, a tiny bit. I mean, it started a couple weeks ago, not this past Friday, but the one before, where you kind of saw this really strong participation on the part of small caps that carried a little bit into the middle of last week. And even, last week as a whole, you had started to see an outperformance of small caps and cyclicals relative to kind of mega cap tech or anything sort of tech adjacent. So I think, it's a good sign. It kind of always starts out a little bit as short covering, kind of, just buying up the names that were heavily beaten down. So to the extent that gets carried through, I think that's kind of the next hurdle that you have to clear. Our kind of view about this is that you're close to 8 months off the low from October. So if that was the low, we'll never know until we know. But if that was the low, I think what's going to be really important to kind of think about, especially at this stage, is, we're not really checking off a lot of the boxes that you would typically see in terms of the strength of a bull market. So number of highs on a 52-week basis, new highs, the percentage of stocks trading above their 50-day or their 200-day moving average, that is all yet to be cleared. So I think if it was the start of a new bull in October, I think it would go down as one of the weakest in history.
And so for a lot of the melt up that we've seen, it's been FOMO driven as well to a certain extent here. Yep. So even if we were to see, not collapse back to October lows, but even if we were to see some type of retraction, would that mean that on the other side, FOMO can't drive it once again? Would that be kind of a sans FOMO type of rally that we would need to see in reattachment to some of the more firm fundamentals?
Yeah, I mean, I think for us, the most benign scenario and sort of the best case is that you kind of have a stabilization in those larger cap areas and then just catch up from the rest of the market. You don't have to see this, huge collapse, like you said, at the top of the market. That would obviously drive, a lot weaker performance at the headline and the index level. But even if that happened, I would look for kind of the reverse of what we've seen year to date. So if that was happening where, the Super 7 or the Mega Cap 8, whichever moniker you want to use, if those were collapsing but the rest of the market was participating and doing well, we would take that as a pretty bullish signal. Obviously, it's going to put more weight on everything, but that's exactly kind of what you had at the October low. The problem for us is it just didn't carry through. It only lasted for about a month or two.
And what about these sort of anecdotal bummer signals that Saz referred to in his piece? The sort of consumers may be trading down in some cases, the rhetoric that we're hearing from a lot of CEOs where they're really trying to put a dampen down expectations.
Well, I think that's part of the hard part about what became, defense in this, I don't want to say new era, but at least in the pandemic and then kind of the few years after, is definitely during the pandemic in 2020. Those defensives were the big tech names. And so it was really just the big five that were kind of driving returns. That has kind of, returned this year, where, they're not companies that have no earnings and they're low quality. Right. I mean, they are relatively high qualities in almost every metric. So it makes sense why people have flocked to those names. But at some point, it becomes a chase. It becomes the fear of missing out trade, but I think also the fear of getting out trade, where you're kind of hesitant to leave those areas and go to the rest of the market. So when you start to see that, I think it's going to be a better signal. But to your point about trading down, I think that's probably more of a theme this year because you don't have as much of the savings buffer, you don't have as much of the income growth that you had as the labor market continues to soften. You still have it in aggregate terms because we're still hiring a lot of people, but it's not as strong as it was maybe 12 months ago.
Yeah. All right.
Okay. Kevin, stick around. Thank you.